You're listening to The Wealth Advocates with finance experts John Nicholson and Patrick Jenkins. The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future. Here's your host, John Nicholson.
Well, welcome to the next edition of the Wealth Advocates podcast. I'm here with Jeff Bickel, who I'm going to let him introduce himself and tell us a little bit about who you are and what you do.
John, thanks. It's great to be with you today. Like you said, my name's Jeff Bickel. I'm a tax partner with a local firm, local accounting firm here in Salt Lake City, Utah, Tanner LLC, about 160 people. And I've had, for the last 26, 27 years, been doing all sorts of tax work with individuals, partnerships, corporations, all sorts of other types of business entities. So we do a fair amount of planning for individual clients as well as business taxes here. So anyway, good to be with you.
Yeah. In fact, we were just talking about the fact that we started relatively close to each other in terms of our careers.
Yeah.
And in little different fields, but it's been a good thing especially looking back now. But that's part of the discussion today is I wanted you to kind of give your background or your thoughts to, and maybe this is a good place to start, is this is an unusual year for a lot of reasons, and not just because of the virus and all that it implies. One of the changes was the change to the tax deadline, which I don't know, has that ever happened that you're aware of?
No, not in my 27 years of practice.
Yeah, so that's such a crazy thing. And so with the tax deadline being pushed back to July 15th, how has that changed the way you approach the planning and maybe even with some of the other things that have kind of jumped into to fill the gaps as far as planning goes? What's changed and how has that changed the way you approach things?
Yeah, it's really been interesting, and mostly just, John, with timing of stuff. People, the pandemic has been so on everybody, the forefront of everybody's mind, that they just have not been, frankly, as concerned about their tax situation. And so even though we tried to push and still get a lot of stuff done by April 15th, because we didn't want it to push out into the middle of the summer, we've had a hard time actually motivating clients to get their stuff ready and get going on this stuff. And so it's kind of extended our busy season in a way. We've been putting in more hours in months where we wouldn't normally, just because of the fact that the deadline's been extended. Mm-hmm. And so it is causing us some issues. It's what's really interesting about that is we have a lot of clients that file in multiple states. And so even though from a federal perspective, they extended that deadline to July 15th for both estimated payments and for tax filings, a lot of the states did not follow suit. And so we're trying now to manage all of the different deadlines as we prepare to make estimated payments, as we prepare to get their final tax filings done and stuff like that. So it's been very challenging, but the other interesting thing is for our people who normally work a gazillion hours in March and April trying to get, everything filed. Again, they didn't work as many hours, it wasn't quite as many hours during the busy season, but they're working a lot more in May and theoretically June. But in a situation where all they can really do is stay at home anyway, it's not necessarily such a bad thing to have work to focus on instead of just focusing on the pandemic. So
how many accountants do you have?
Oh heavens! In our tax practice, we have just about 35.
Okay.
35 people.
See, so changing that push to April 15th. That does change, especially from the side of managing the company.
Absolutely, yes.
So it's gotta be a big
definitely
challenge.
Change the dynamics. We have 160 people here total, and so working remotely. I mean, John, we serve somewhere in the neighborhood of 3,000 clients, and so it's working remotely has been challenging, and yet people have stayed really productive and efficient even through what's been a really crazy time.
Yeah. Well, and my guess is the wave is still coming because I know from my side of things. I know that when you're doing your job, I'm getting tons of calls for tax documents and histories and corrections and things like that. So, and I haven't seen much.
Yeah. A
little bit, but not that much.
Yeah.
So I know it's still coming.
100%. The wave is still coming. And I just hope that, it's a really tough thing, right? Because, when it feels like right when travel restrictions are going to get lifted, is when our deadlines are going to be here. And so it's going to be tough. It's going to be tough.
Well, and those keep pushing out. I mean, every time they tell us, it's going to be the 1st of June.
That's right.
And everybody knows that means we'll see.
That's right.
So that's going to be, I'm assuming the July 15th will probably be a pretty a pretty firm deadline.
Yeah, yeah.
But the other ones, I don't know.
Yeah, you would expect that by now, but as with every year, there's still a ton of clients that will get extended on July 15th, and they'll push out until October 15th for the individuals. So
do you think that, because the attention has been so much focused on the health concern, the public health issue, and it really does distract from the normal attention to tax, do you think that's going to create a lot of problems approaching the deadline, or even just in general in terms of people's planning?
Yeah, that's a great question, and the answer is yes. The biggest challenge we're in right now, and you're seeing it in your business as well, is that 2019 was a remarkable year for the stock market, and there was a lot of gains recognized, a lot of dividends, a lot of capital gain distributions. And coming into 2020, now we have to pay the tax on all those gains that were recognized in 2019, and yet we're in a market where things are generally down, right? You know better than me even, and so the biggest reason, in my opinion, that the deadline got extended had nothing to do with whether people were working remotely or in difficult work circumstances and things like that, but it was a matter of, can people generate the amount of cash necessary to now pay their taxes? I had specific people that I've talked to who said, yeah, I put all my tax money in the market and I can't afford to liquidate it right now to pay my taxes. And so, having seen a little bit of a recovery over the last couple of months, and I shouldn't say a little bit of a recovery, a big recovery over the last couple of months, has really been helpful to a lot of these clients that were going to be in a really tough position. So,
well, and even to our audience, that's one of the major points is, right now the market has recovered dramatically. If you look from the first of the year, in fact, a lot of people are still under the impression that we're really dramatically down. We really aren't. And so it is an important, especially if as we've called and talked to people and we've said, okay, let's really assess where we are. When we planned last, we said, here's what we need for safe money and for medium range and long range. Did we do the right amounts? Because this is a good test to the whole system. Is it really working the way we thought? And if you're thin on your short-term money, meaning taxes and anything else that may come up in the next 12 months, now's a good time to be assessing that, because we're in a better position than we were even a month ago.
Yeah, no, it's a great point, and I encourage all of my clients always that we need to set aside a very conservative bucket always for prior year taxes to make sure we don't get into this situation.
Yeah, and I see that, especially whether it's mine or competitors. I see a lot of people will put their attention on the longer term growth assets, which is good, and that's really kind of the core of what we do. But you still have to have some on the. When we talk about the areas we cover in financial planning, the very first one is what would ruin the whole plan. Right. And everyone thinks obviously about health insurance and life insurance, things like that, but cash, people overlook that constantly.
Yeah.
It's probably the most abused area of our planning, because something will come up, something will disrupt.
Yeah.
And so, now is the time to say, do I have on the sidelines what I need to have? Especially now that we see, hey, those that have cash on the sidelines, it is so tempting with the market being down to say, hey, there's opportunity. Yeah. And there is. As long as you've got the cash in place, tons of opportunities are coming up.
Yeah. No, 100%. And that's one thing, obviously, we're still doing, because we are seeing some M&A activity, interestingly enough, and with those businesses being purchased, we're even now doing forecasts for 2020 and what kind of cash people need to set aside. And I think they're more serious about it this year than maybe they've been in the past in terms of setting aside. But the interesting thing, John, is that people's minds haven't been as much on taxes as on all of the other kind of economic factors, the stimulus packages, the CARES Act, the money that people are getting in stimulus money, the families are getting and stuff like that, and the PPP loans, the Paycheck Protection Program loans. We're getting, there was a period there where that's all the questions that we got.
Yeah.
And we're not necessarily expert in that, but we became expert very quickly because we were having so many questions.
Yeah, until tomorrow, until they shift it again.
That's exactly right. Until they issue a few more frequently asked questions that everybody will be surprised by. So anyway.
So expand on that a little bit with what you're seeing in both the fiscal and the monetary stimulus, these different packages that have come out. First of all, from a planning standpoint, how has that affected clients? How has it affected the way you give advice?
Yeah, it's a good question. Obviously, with the Paycheck Protection Program loans, it's just a matter of you're either going to qualify for forgiveness or you're not, is what it comes down to. And certainly we're trying to, honestly, John, there's companies that literally have been at zero revenue now for a couple of months. I mean, theaters and some restaurants and stuff like that. And so that's just really cash flow management more than just about anything. But in terms of planning, there are some really, really significant opportunities associated with that, because to the extent that people are recognizing, business losses and stuff like that, we can use that to help them, obviously, with their tax situation. So a couple of particularly important things that came out of the CARES Act from a planning perspective, at least for businesses, for corporations in particular, was that the net operating loss carryback rules got changed such that now you can carry those losses all the way back to 2013 and recover taxes that you've paid in the past. And so that's one of the biggest things that we're working on right now is planning with corporations to carry those losses back, because what you have to remember is that corporate tax rates back in those years were 35% at the maximum, and right now they're 21%. And so if we can use losses to offset income that was paying it at higher tax dollars, then obviously that's a huge planning opportunity. One of the other big things that came out of the original CARES Act was the fact that what we call leasehold improvements or qualified improvement property in the 2017 in the Tax Cuts and Jobs Act of 2017, that stuff all got lumped in with 39-year property for depreciation purposes. Well, they finally made the technical correction in the CARES Act, which said that that can all be treated as 15-year property, which means it's available for bonus depreciation, or you're able to deduct 100% of those fixed asset purchases in that year, and it goes all the way back to the effective date of that Tax Cuts and Jobs Act. And so we've been doing a lot of amended returns, frankly, to increase people's losses in those years.
Yeah.
And so anyway, those are a lot of the things that we've been doing in terms of planning for companies, at least.
And particularly valuable in terms of losses against gains. We'll talk more about that. But let me come back to a little bit on the tax side. I mean, with where we are right now and the amount of stimulus spending, the amount of additional debt, I want you to talk a little bit about what impact you think that's going to have, adding to the national debt, what each of these acts have meant to that. And then, we'll come back to kind of what happens if there's a Republican control versus a Democratic control.
Sure.
But first, talk a little bit about what you think that means in terms of national debt and each of the acts that were passed.
Yeah, no, I appreciate the question, and obviously I can speculate with the best of them in terms of what will happen eventually. But you have to look at it and say, even without any stimulus related to the pandemic, we were going to be another $1.1 trillion in debt this year. It's the way that our federal budget works. They just spend more than they take in revenue. And so you were looking at a budget deficit of about 1.1 million, a total deficit of somewhere in the $25 trillion range. And so adding on the additional CARES Act, which was about 2.4 trillion, and even now there's another bill that's actually passed the House and is sitting at the Senate, which would add about another 3 trillion of stimulus dollars. And so my concern for my clients is that eventually, if you're going to add another $5 or $6 trillion to the deficit, somebody has to pay for that at some point. And whether it's us or our kids, I think that there's a very likely scenario that one of two things happen. One is it creates a situation of inflation, right? Because if we just start printing money, right, that's going to throw a bunch of extra currency in the system, and we're going to go into I don't want to say hyperinflation, but certainly the opportunity for inflation will be there. Yeah. The second big thing that I see, and you talked a little bit about this, is about what happens to tax rates in the future. I mean, right now, the individual rates obviously came down from 39.6% at the maximum to 37% at the maximum. Corporate rates came down from 35% maximum to 21% maximum. Capital gains rates didn't change, right? We're still at 20%, but that's actually a really good rate relative to other individual tax rates. But how in the world we're going to be able to pay down any debt when even, currently we're collecting less than we're spending? It does make me nervous that we're looking at sometime in the future at those tax rates being increased again.
Yeah, I used to joke all the time that the government is like an irresponsible young couple, that they don't have a revenue problem, they have a spending problem. Now I don't think that's the case. I think it's both. Yeah. I think they have a revenue problem too. And so I kind of agree that I think that I doubt anybody's going to argue with the fact that somehow we've got to have more revenue and we've got to control the spending. I don't know that we'll ever control the spending. I can't see how they will ever pull back.
Yeah.
But the revenue side, yeah, I think they're going to look under every rock for more revenue. And that is going to mean, I mean, in 2026, we know that the whole tax law as we know it is going to sunset.
That's right.
And then it will go up at least that much more, going back to where we were before.
Yeah.
But my guess is that if Democratic control takes over either the presidency or the Congress or both, that those will not even be enough. There will be a lot more.
Yeah.
Is that kind of where you feel like there's momentum?
I think that that's exactly right. And the interesting thing, I just had a client call me this morning. So you're talking about planning, right? So I'm on a Zoom call this morning, which,
Yeah.
I'm typically spending now 6 or 7 a days on Zoom calls, which is driving me kind of crazy. But in any case, I was on the call with a client this morning. We were talking about the exact same thing, about potential increases in tax rates. This particular person is experiencing a large capital gain this year relative to the sale of a portion of his business, and is saying, obviously I want to plan the best that I can, but I feel like 20% is a great rate to pay, because
Yeah.
it's capital gains versus ordinary income. And he said the interesting thing is that, if rates do go up, if we do in fact change, from a conservative to a more liberal position back in Washington, that it's not the people that even received the stimulus money that will be paying back all the debt.
Yeah.
Because what you're going to see is taxes increase dramatically on, those who are making over that threshold to even get
the
any
ones that
stimulus
didn't
money.
take it will
That's
be
exactly
paying.
right.
Yeah.
So anyway,
Yeah.
just anecdotally.
Yeah, no,
he
it's
was
actually,
interested in that.
it's a funny just how things have come around. So one of the things, I guess, going back to that, if we believe taxes will be higher, that would argue there's a sell on taxes now, and what you said before about, can we take advantage of, lower rates or lower income thresholds this year if people are down a little bit, or if they have the carryover losses. Where are the planning opportunities in your mind in those things, in those scenarios?
Well, there's a lot of different things we can do. One that even you and I have discussed a little bit was just talking about, conversion of traditional IRAs into Roth IRAs.
Mm-hmm.
So as you know, and probably most of your clients know, if you do a conversion from a traditional IRA to a Roth IRA, all of that, the gain is income. In fact, the entire thing is income on your tax return the year that you do the conversion. And so what I'm seeing this year is, to the extent that people have business losses that are flowing through, maybe from a partnership or an S corporation, that they can use to offset those conversions, be a fantastic year to push all that money into a Roth IRA situation and avoid all future earnings. And particularly where the market's at a low point right now, you should address this, but the market's at a low point right now, and so the value of those dollars is probably less than it has been in prior years.
Right.
And so we may be able to convert those into Roth right as we're going to get another run up in the value of those IRAs. And
The idea is the double effect. I mean, you'll have, hopefully you're converting at lower prices, which then you have the run up that becomes tax free. But also, I mean, you've got the tax rates being lower also.
Right.
So, I mean, the double effect is pretty attractive. It's pretty hard to argue with.
Yeah.
Although the flip side of that, the challenge to that is still going to be cash flow. And you've got to have the money to pay the tax.
That's right.
And so, obviously the tax losses are going to help a ton with that if that's the case. But again, I mean, we started kind of in the same line of thinking. Do you have sufficient cash for that kind of a planning opportunity? And right now in this environment, it's hard not to hoard and say, hey, I better make sure that I'm okay, because who knows what's going to happen in the next, I mean, we felt that way for 3 or 4 months. What's going to happen in the next couple of days, let alone a month or 2 or 3 or a year?
Yeah.
So that's one of the challenges, is really assessing the planning. And that's where it becomes everybody's financial fingerprint is different. And you kind of have to assess each circumstance. But I do think there's a huge opportunity there if you're in the right position.
Yeah, no, I agree 100%. And in fact, the one thing I didn't mention as part of the CARES Act, one thing that it did is suspend. So in 2017, in the Tax Cuts and Jobs Act, they basically said you could only take business losses to the extent of $500,000 to offset your individual income. They actually suspended that rule, and so you now can take, at least up to your basis in the investment, an amount up to whatever losses you have. And
Yeah.
so, and by the way, you could also generate losses to the extent that you can by those additional depreciation deductions that I was talking about.
Yeah.
And
So you look at 2019 being a phenomenal year. Maybe there is an argument for refiling and reclaiming some of the losses.
yeah, that's exactly right.
I mean, it would have been a lot easier if we'd had the bad year before the 2019
That's
year. And
exactly
right. That would have been easier. But to that point, I mean, even from our perspective, we're looking at it and saying right now, how are we going to best effectively recognize as much loss as we can to carry forward,
Right.
and make sure we're as efficient as we can be from the tax perspective.
Right. Yeah, that makes very good sense.
So, so any other general planning ideas that have been of note that you're seeing for the year? I mean, because this is such a weird year that, and I don't know if there are beyond that. I'm sure there are on an individual basis.
Yeah, and that's the thing, is it really just takes a few minutes to look at each individual, separately, uniquely, and determine their individual circumstances
Yeah.
to figure out what might make the most sense. But where we can be of most value, where a CPA can be of most value, I think, is when people are running, particularly for entrepreneurs who are operating in a flow-through type business in partnerships or S corporations, because there's an awful lot of things that we can do at the business level that will ultimately be hugely beneficial for the individual and their tax situation.
Yeah.
So that's typically what we're looking at.
Well, and that's been really valuable to kind of get your perspective on, the broad topics that help people, but really, I mean, in most cases, that's why we do what we do, is on an individual level, there is just so much that has to be considered to decide what tools are the right tools to use.
Yeah.
So, well, I think we'll wrap up there. Really appreciate you being with me. And,
John, appreciate the opportunity.
Hopefully we'll transfer a few ideas to our clients and friends that are valuable for them to use, and we'll look forward to another edition in a month or two. So thank you very much for being with us.
Thank you for listening to The Wealth Advocates. Join us every month by subscribing on Apple Podcasts, Spotify, or Google Podcasts. You can also look for The Wealth Advocates on Stitcher and YouTube. Want more information about today's topics? Reach out to John or Patrick directly by calling or texting the Wealth Advocates office at 435-754-7888. Learn more about the Wealth Advocates and how they can help you by visiting wealth-advocates.com. Securities offered through registered representatives of Cambridge Investment Research Incorporated, a broker-dealer member FINRA, SIPC. Member FINRA, SIPC. Advisory services offered through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Wealth Advocates and Cambridge Investment Research Incorporated are not affiliated.